Hello and welcome to Fidelity Connects. I'm Pamela Ritchie. After a strong year for Canadian markets, investors are taking a closer look at what's driving returns for this year. Gold and energy have moved back into focus, and Canada's industrial base is beginning to take shape again. Our next guest believes this is exactly the kind of environment where selectivity matters more than broad exposure. So what does he say? What does he say that active management matters, and how does it matter more now, and where is he seeking opportunity? Joining us here today to discuss all of this further is Fidelity True North Fund Portfolio Manager Maxime Lemieux. Great to see you, Max. Thank you for joining us from Montreal. How are you today?
Good. Good morning, everyone.
Great to have you joining us here. Okay, so let's begin with what a year it was, certainly last year. And one of the big questions is is it repeatable in the Canadian markets? You're sitting in the midst of, you've been doing this for years. What did last year mean? Has it wrapped, and where are we going?
I call it a vintage type of year. Over the past 30 years, well, soon coming up to 30, it's been impossible to predict such a movement. You know, we met last year talking about the first grenade from Washington in terms of potential tariffs and so on. And I would have never been able to predict such a strong recovery for the Canadian market, you know, finishing up more than 30%. Obviously, when there's so much sentiment and speculation, especially in gold and metals, and it's been a heck of a year. I think it's hard to repeat this, but there are trends that we think, again, personal view, trends that might continue to remain in place for the next year or two. We'll see. As you know, True North takes we have a long-term view when we invest. It's usually over the next 3 years plus. It's not day trading. But last year was very special because everything went up at the same time. Reminded me a little bit 2010, 2011, where the very speculative companies were just, going after returns of 20, 30%, and small cap also. We've seen a bit of a broadening marketplace coming towards the end of the year last year. But I would say gold and copper and all these metals, including energy, as you mentioned, was also important. Not necessarily because the price of oil has been as positive as gold. Remember that gold last year was up 60%, and the Canadian gold equities were up 120%, so it's a double. But energy, remember, there's been huge improvements out of Calgary over the past 10, 15 years. Consolidation, better management. So the cost of producing gas and oil has improved quite a bit. Lower discounts on oil. And also the new pipeline, Trans Mountain, allows us to export internationally, so less dependent on the US Gulf Coast. And to top it off, as you know, LNG Canada has just started last year. It's going to start to export more. There'll be 2 more terminals over the next 3-4 years, and therefore they'll probably consume up to 10% of natural gas production in Canada. So short term, not necessarily a lot of excitement for the commodity, the natural gas per se, but I think that given the ongoing geopolitics, we need to continue to take advantage of those resources that we have. And we have not even talked about nuclear. Nuclear was topic du jour also last year. I'd like to remind the audience that 2 of the 3 nuclear technologies in the world are controlled by Canadians, i.e. Brookfield and Cameco, both own Westinghouse, which is an American technology.
And has a huge contract with the US government. Yeah.
Yes, absolutely. So those are long-term duration, right? We don't always have all the details short-term. I mean, as you know, Washington keeps us on our toes every single day. We don't always have full transparency, but we know what's the direction of travel. And that's important. And SNC, the old SNC, which is Atkins Realis, that owns the CANDU technology, which is more in Europe, but they'll try to probably enter the US market as well. So we'll see how that's going to pan out for these names. Doesn't mean that we own it today or if we're buying or selling. But I just want to mention that Canada on the resource front, there's a lot also being supported by, as you know, since Carney's been elected, supporting these 5 large major projects. And one of them that was in the top 5 was Foran, which is a copper mine, which is about to start, I think, next year, out of Saskatchewan. Well, that's a name that, as of the last filing, was in True North, and we were in that name at that time for a long time, actually, for more than a year. So there's more to come. And this narrative is not changing in the short term. So it's hard to say what's coming up next year, over the next 12 months. But if commodity prices just remain where they're at, a lot of companies in Canada, whatever, if they're energy or rare earth or copper, if the commodity prices sustain themselves, like, you have companies that generate good free cash flow and good returns to shareholder.
And you're right in the middle of it. I mean, you just used that example of the mine in Saskatchewan, which has now been picked up for bigger and greater and better things. And you've been there for a long, long time. I mean, you've been maneuvering this market and knowing the intricacies of it for such a long time. And it does feel like, I mean, so it sounds like you're saying the moment is continuing. This is something that's going to run for some time.
That's what we feel. Again, I've given up on my crystal balls. The past 3 years have been quite something. And the definition of a cycle, I think, has changed quite a bit.
Okay.
I'm not going back to university, but I think what we've seen is unheard of in modern history. Think about it. The last recession was 2009, sorry. COVID was a 2-week recession. So it's very interesting. And again, rare earth, like there's a company based in Montreal, they've been involved in this whole chain. And as of the last filing, we had been shareholders for many, many years in that company. And sometimes to wait a bit more when you see that incrementally these companies are improving on what they do and expanding, the payoff long-term can be very attractive. And that's what we're trying to do. And what people don't see necessarily, the investors, is that we try to manage risk in absolute terms. Okay, so we're not a benchmark hugger. And sometimes we're ahead of the crowd. But when it becomes really exciting, we're not going to necessarily be overweighted, especially in Canada, where the stock market is not the index is not as diversified, right? So it's a different type of marketplace in Canada. And if we want to protect shareholders' money, especially during downturns, because there will be shakeups at times. We've seen it over the past few days with AI's impact on software, and it's nothing new, but there was another breach, right? So you don't know what's going to come. We don't know if there'll be another statement from Washington that will just mix up all the cards out there. But the background is, again, there's a direction of travel. I think Mr. Carney's trips in China and Europe, I think he's maneuvering not to escape or a potential renewable of the NAFTA or of the USMCA, but I think we always need to have a B plan. It's like when I do my homeworks with my analyst, right? We try to measure what is the absolute downside scenario and what is the upside. And that's what we do all the time on all the stocks. And I think Mr. Carney is doing this. He needs to prepare a plan B and probably a plan C, because we don't know what's going to happen when July comes. Will there be a full renewal of the free trade? Or is that going to be just no renewal? So therefore, it keeps going on a yearly basis for 10 years. Or, as you know, the default option is that any of the 3 countries from July and on can exit on a 6 months notice. And that would be the optimal, the absolute downside scenario for the industrial companies. So what I want the audience to remember, the industrial economy in Canada, since 1987, the first free trade agreement between Reagan and Mulroney, 1988, I believe, part of the industrial sector in Canada was about 18% of the market. And recently, as of last year, I think we touched a low of 8% or 8.5%. Okay. So because natural resources were available or part of that free trade agreement, unlike most of the free trade agreements in the world that have taken place over the past 30 years, well, we tend to specialize in what we're best at. And When your largest client is just down south, it's easy to ship, right? Train, truck, whatever. So that's what happened. And now, because of the geopolitics, we need to spend more on defense. And usually spending more on defense helps a country or an economy to rebuild its own industrial base. And I think that's what we're going to see over the next few years. And we've seen a lot of Canadian names that have had quite a move last year just based on that prediction of more spending.
For sure. And so it's just fascinating just to watch this roll out and with your expertise behind it, being able to shepherd people through, where there's an opportunity now and when it's perhaps a bit early to take a look at things. You'll know that better than almost anyone. When you take a look at the geopolitics, I don't want to bring too many of them in here, but for instance, there's a discussion of whether oil is going to feel the global crisis is a bit of a shock. There are things going on in the Middle East. We don't know if it'll be a nothing or if it's something that goes further. But again, just tell us a little bit about your energy positioning within the fund at this point.
Well, listen, without naming specific names, we've always been quite involved with royalties type of companies where the different moves in commodities are not necessarily going to have the same impact as a producer. You can think of the refiners. They can have a great run, especially if oil stays at a lower price, right? Because their margins improve by default. And we've got some secular stories, including also some of the pipelines, right? Some of the pipeline companies, especially for natural gas. We've always believed that natural gas is a bridge towards a greener world. I've not, changed my personal view on this. Mm-hmm. Same thing as rare earth or some metals will be needed for this ongoing transition. But there will be hiccups. But in terms of oil and gas, I think, as I've mentioned earlier, a lot of these companies at $60, $65 oil are more profitable than they used to be. They're just better companies than they used to. Now, of course, given the geopolitics, if you tell me that oil goes to $50, some of these names will go down. That there's no doubt about it. And there's a currency also that we need to factor in. But I cannot promise, and I don't know if there'll be another oil pipeline, right? It's not crystal clear. I think based on my readings and our discussions with CEOs of different companies, it looks more like we might have a great opportunity to continue to expand on the current infrastructure that has already been built, as opposed to building a brand new pipeline. Okay. But that alone could increase quite a bit the overall exports.
It's all about the capacity and the export piece. So if it gets there,
because you want to diversify away from the U.S., right? 80% of what we ship used to be in the U.S., right? So you want to play your cards well, because now we don't know what's going to happen in Venezuela. But if Venezuela were to become, or to go back to what they used to produce, which was like 3 million, I think, a year, they're at 800,000 barrels a day, I think. Used to be closer to 2. In the heydays, I think it was 3 or slightly above. It would take years. It takes a long time. Remember when the U.S. invaded Iraq? It took them more than a decade to bring back the production that Iraq had back in their peak. So it takes a lot of time. And again, I want people to remember, we have a diversified economy. And as I said, uranium, nuclear, copper, the gold companies have a lot of byproducts as well. So it's super interesting to see where Canada sits right now. And I'll tell you, I was speaking to an old friend in Boston a few weeks ago, and he was mesmerized about why are investors not more enthused about the Canadian marketplace, given all the resources that we have. And if the world continues to, go through a duplication of all the supply chains as a result of the geopolitics, Canada sits very well. Like we talked about this when the Russians invaded Ukraine.
Hello, investors. We'll be back to the show in just a moment. I wanted to share that here at Fidelity, we value your opinion. Please take a few minutes to help us shape the future of Fidelity Connect's podcasts. Complete our listener survey by visiting fidelity.ca/survey, and you could win one of our branded tumblers. Periodic draws ending by March 30th, 2026. And don't forget to listen to Fidelity Connects, The Upside, and French Dialogue Fidelity podcasts, available on Apple, Spotify, YouTube, or wherever else you get your podcasts. Now back to today's show.
Absolutely. Well, and that was the beginning of one piece of the gold trade, certainly. There's more to it perhaps now because it's a gathering storm to an extent. We saw gold fall out of bed last week for sure, maybe linked to the new Fed nominee, head of the Fed nominee. I don't know what you think about that, but where does gold play a role going forward? I mean, it's maybe it was a buying opportunity for some people. It seems to be okay today.
Maybe. Listen, in terms of how I perceive gold, like I always had this soft rule since I've been a fund manager, like gold is very much based on sentiment, right? It's not a productive asset. So as a result, all the funds I've managed previously, usually I've got this 10% threshold as a percentage of the total assets of the fund. We were in gold last year, 2 years, 5 years ago. And now, as you get more advanced in that cycle, people go from the large cap to the smaller and mid cap companies that become more speculative. They want a bigger bang for their bucks, right? So it's something where it gets a bit harder for True North, which is a $7 billion plus fund, to get involved with. But we're always on the lookout for interesting opportunities that will have potentially a long duration, no matter what happens with the gold price. But the reality is we've been underweight over the past couple of months just because now it's way above 10% of the TSX, as I've mentioned to you, and therefore more than 10% of the fund, a little bit more. So I'm just a little bit careful on short term, but the reality is that nothing's changed. The central banks have increased their reserves, but they're not buying as much as 2 years ago. So last year, we just saw the numbers. Central banks bought a little bit less last year versus 2024, but there's still a trend. And now over the past 6 months, it's been all retail money and institutional investors coming in. Now, the dynamic, look at the Venezuela, the more land grab that we see, or the more changes that were unexpected in the previous world order, this I think will keep people interested in gold. And also I'd like to mention something.
Please.
As you know, I've never been a big bull or a strong believer in cryptos. But over the past couple of weeks, months, there's been articles about quantum computing being able to break in the codes for cryptos. And it's very interesting that over the past, month or so, we've seen really cryptos being under pressure. Obviously, gold has decoupled like last year, but I think that people realize maybe that to own something that is really tangible, we've seen these queue of people going to buy silver and gold in the US and the UK. Like, I don't know how many coins now are sold out at Costco. Like it's a bit crazy. And when you look at the rate of change, when gold reached 5,000, it was, I think, something psychological, which coincided also with the nomination of the new Fed chair, who is, by the way, an investor. His whole career has been, he was a banker, investment banker, and then he went to work with Stanley Druckenmiller, who's one of the most famous stock investors in the US. A bit less well-known because he just runs his own family office since he left George Soros many years ago. But Scott Bessent worked at Soros with Stanley Druckenmiller, and he's in charge of the Treasury. And you've got now Mr. Warsh, who will be heading the Fed. So these two individuals understand the stock markets inside out. So that's very interesting that now you'll have two voices next to reporting to Mr. Trump in some ways. You would like to believe that the Fed will remain quite independent. And we'll see. Mr. Warsh understands markets. We'll see if he's going to be a dove, like some people pretend, or if he's going to be a bit hawkish. It's not crystal clear to me what will be the approach. I don't think, again, personal view, I would not be surprised if in the short term rates could go down a little bit more. But at the same time, the economy in the US, despite the fact that it's a K economy, right? The bottom 20 percentile is still hurting. It's hard to get by. Inflation is not disappearing. But the economy, CapEx, infrastructure, these CapEx from the large four players for the data centers geared towards AI keeps going and represents 75% of the overall CapEx in the US. They're still onshoring. And we're starting to see, it's earnings season as we speak. So we see the backlog of major industrial companies starting to increase because it's been 3 years of complete stagnation,
Yes.
right? So those PMI is starting to move, but the stocks have already had quite a move since October already.
You mentioned crypto. I want to ask you a little bit about AI and the discussions, because all of the components that you've been discussing in many cases will be components of the AI build out, the commodity side of it, the energy side of it, certainly. Something that we've seen in markets has certainly been a reaction from software being displaced essentially by what AI can do for companies. I just want to kind of get your thoughts on that. For a long time, software has been a very interesting place to invest, but lots of investors are questioning that right now. What are your thoughts?
It's a great question. Very hard to have a clear-cut answer or to have an answer on a timely manner.
Yeah.
Again, I think there's a roadmap or a direction of travel, but in terms of sequence, hard to tell you the when and the what. But here, I'd like to share a personal experience, a discussion I had with an acquaintance of mine who's been involved in enterprise software his whole life, knows AI intimately. He started a new company about a year ago, which is enterprise software, but based on AI. And basically, this gentleman told me recently, he could basically bring up a product that he's basically been showcasing and using. So there's a core client using his new solution that was all AI built. And therefore, he told me, I can do a lot more faster thanks to AI. So he could do this with, I think, half the number of engineers. And I forgot in terms of amount of time, but it was much faster. But here's the hook or the pitfall. Where he was misled, his client is super happy, but he cuts back on engineering, software engineering, but where he had to hire a lot more people was on the design part. So it's easy to bring up a new solution, but it's a generic solution. And then you need to adapt and tailor it to the need of your customer who might be in a totally different industry, different sector. So you need to do that. You need to do that work. And that's more labor intensive than expected. So it's just to show here that, listen, it's been a carnage year to date and started last year for this software sector. Mostly, well, not only enterprise software, but all kind of software companies, including info service type of software. We've seen Thomson Reuters and Relics in Europe. We've seen some of the stock exchange that have a business model that is more based on info service as opposed to just commissions and trading. It has a lot of ramification. But the example I just shared with you is, I think that this is happening a little bit too fast because we've got the proof here that there's another aspect of a software solution that is based on tailoring it and making this tangible to the users. And that has nothing to do with AI per se.
No, that's the layers and the nuance and the idiosyncratic way that you would take a look at companies and the theme and obviously the sort of shock to the market that is being endured by software right now. That kind of leads me to your ability to take a look at companies that would maybe be private at this point, probably tech companies that are private. You do that. I know that you have a wide knowledge. Do you actually invest in the companies as well?
We still do. Not in the case that I just mentioned to you. That's way too early. Usually we like to invest in, if we invest in some private companies, we like them to already have some kind of revenue generation. And as we speak, we do own 3 to 4 companies. It's probably about 1% of the portfolio. So it's nothing very risky. We try to mitigate the absolute risk again, but we're super enthused about, 2 of these companies actually right now are very interesting. They've seen their backlog growing. One of them is related to automation. I've talked about all these backlog for these large industrial companies where it's increasing recently. And some of these companies, they're unicorn. It's just a question of time. We saw actually just 2 days ago out of Quebec City, there's a company that was purchased for $2 billion Canadian. by ASAB, a large U.S. industrial company. Too bad that we lost that.
Too bad that we
company,
lost it. Yeah.
But we have that, and I want people to remember, long-term diversification will always pay off. And it's one thing to chase the metals and the gold and the oil or the energy or infrastructure. We have to remind ourselves that technology, despite AI, there'll be new winners out there, and we have to be on the lookout for these. And that's why we do that extra homework to keep an eye on some of these private companies.
So it's fascinating. And I think Charles Denis had a conversation with you in French just before this, and this was actually a question that he was asking of you offline. We were talking about it. But the idea that probably a lot of investors last year would have done very well just owning the TSX. You know, that worked pretty well for a lot of investors. I guess the difference between, there's a carry-on of what went on last year and some of the themes, but what's a bit different and nuanced and, you know, frankly, requires a more active approach? Because last year you really could have owned the index, actually.
Yep, absolutely. Listen, last year, it's bittersweet, right? For any active fund manager like ourselves, when you're up in absolute by, 24, 25%, but your index is up like 30, 32%, whatever it finished at, you're super happy in absolute terms. You might think that Christmas, there'll be nice gifts under a tree, but you still have this pressure or this sense of you're not completely fulfilled or satisfied because you could not beat the benchmark. The perfect year is when you're up in absolute in a nice way, and when you beat the benchmark. That's not what happened last year, unfortunately. It was extremely hard to beat the benchmark for all the reasons I've mentioned, like the junior gold and the metals just started to run. The Canadian banks also did better than expected. We've talked about this in the past, Pamela. I think since the financial crisis of 08-09, the U.S. large money centers, banks, and the Canadian banks have really cut back on the subprime type of loans. And in Canada, it changes the nature of the risk profile for these Canadian banks, because back in the days, previous cycles, again, that's why we always need to look at history, but we need to adjust our models for the future because cycles are very different. Yes. No recession again since 09. But the Canadian banks cut back on subprime. And now when you've got unemployment at 7%-ish, back in the days, that's when you would start to see defaults on mortgages and different loans. And we've barely seen this so far. So that's been a bit of a surprise, and that's where we probably lagged a little bit last year. But in absolute terms, it was an amazing year. And again, we were positioned for some of these large moves, but we choose to manage risk in absolute terms. And that's in turns, when we have a negative year, when the market is down, usually we tend to fare a lot better. And I think that's part of the approach. And we like to have our unit holders to sleep well at night. It's a fund that continues to perform well over the long term with much less volatility.
And I mean, some of the in-depth knowledge that you have of the companies and often watching with the research that you have at your hands, of what can be overdone. I mean, that's obviously where you go hunting and looking for opportunities. I mean, the sort of software example today, and maybe even gold, I don't know, are opportunities where there's extreme moves, obviously, in the market, but you have a much more nimble approach to things.
Listen, the research is part of our DNA. Our analysts work day and night. We've seen it during COVID. We've seen it recently. There was this threat from Washington, from Mr. Trump, to decertify certain planes made in Canada. Well, let me tell you, as soon as we saw the news, I called my analyst. I think that was at 7 p.m. He was at home. We had a conversation. I could hear his kids playing in the background. He reached out to the company, had a note published the same evening before we go to bed. So I knew exactly what to expect the next day. That we own it or that we don't own it, there's always an opportunity. And in the morning, we had another follow-up together, and I double-checked with the traders what was the outlook in terms of demand for the stock or not. And it played out quite nicely. It was a very interesting day. And legally speaking, we found out a day later that it would be really hard for a president to decertify a plane just without having the infrastructure involved. It's really captivating to see what's going on, because there's always something coming out from the left field that we've not seen. And look, it's part of the turmoil that started a year ago, and we're getting used to it. I think COVID prepared us in some ways to expect the unexpected.
But your experience in the steady hand, there's something to that, particularly when markets drop and your fund sort of sails through with a keel that's a bit more stable. Max Lemieux, I want to thank you for joining us today, sharing your time and telling investors what you're looking at for this year. Thank you.
Thank you.
Thanks for watching or listening to the Fidelity Connects podcast. Now, if you haven't done so already, please subscribe to Fidelity Connects on your podcast platform of choice. And if you like what you're hearing, please leave a review or a 5-star rating. Fidelity mutual funds and ETFs are available by working with a financial advisor or through an online brokerage account. Visit fidelity.ca/howtobuy for more information. While on fidelity.ca, you can also find more information on future live webcasts. And don't forget to follow Fidelity Canada on YouTube, LinkedIn, and Instagram. We'll end today's show with a short disclaimer. The views and opinions expressed on this podcast are those of the participants and do not necessarily reflect those of Fidelity Investments Canada ULC or its affiliates. This podcast is for informational purposes only and should not be construed as investment, tax, or legal advice. It is not an offer to sell or buy, or an endorsement, recommendation, or sponsorship of any entity or securities cited. Read a fund's prospectus before investing. Funds are not guaranteed. Their values change frequently and past performance may not be repeated. Fees, expenses, and commissions are all associated with fund investments. Thanks again. We'll see you next time.